Ladies and gentlemen, good evening. First of all, on behalf of the Italian Banking Association, I would like to convey my deepest gratitude to the Union of Arab Banks and to its chairman, Mr. Eldina Barakat, for inviting us and for having always the pleasure to cooperate also in the organization of this conference. As a representative of the Italian financial industry, I would like to witness our interest in the field of Islamic finance. But before spending some words on this issue, let me underline the robustness and the reliability of our economy, first of all, more in general, but specifically the robustness of our financial industry. Despite the financial turbulence that a number of European countries, among which also Italy, has recently experienced, the current performance of the Italian banking sector is more and more intertwined with the development of the European Union banking framework. As you may know, and I'm sure that my colleague and friend Guido Ravut later on will go much deeper on this issue, the European Union has progressed towards the establishment of the European Banking Union, which will create uniform rules, common institutions, and a shared system for managing banking crises more effectively. The first pillar of the banking union, which consists of the single supervisory mechanism entrusted to the European Central Bank, has finally been approved a couple of months ago, and just 2 days ago was published on the journal of the Italian Bulletin of Laws, when the other two pillars will be completed, namely the establishment of the European mechanism for the resolution of banking crisis and the common deposit guarantee facility. The perverse link between sovereign debt ratings and the rating of banks will be finally broken. As a consequence, major Italian banks whose rating is today equated to that of the Italian state can be expected to face milder conditions when borrowing in international markets. Meanwhile, our authorities are committed to striking the difficult balance between austerity measures required to curb deficit spending and expansive fiscal policies in support to real economy. Likewise, ABI, the Italian Banking Association, in partnership with the Italian government, has been promoting a number of initiatives to ease liquidity tensions in the system and to avoid the risk of a credit crunch for the most vulnerable groups of borrowers, specifically small and medium enterprises and families. The most prominent policy measures enacted by our government in order to ease credit constraints include the expansion of the Central Guarantee Fund for small and medium enterprises, the lending support from Cassa Depositi e Prestiti, the joint stock company under public control, which manages large share of Italy's postal savings, through additional liquidity to the banking sector, the development of new sources of funding for the small and medium enterprises, the recently launched mini bonds for small medium enterprises which are not listed on the stock exchange. So there is a range of initiatives that have helped and are still helping small and medium enterprises to keep in the business despite the difficulties that they are facing today. In Italy, as has been already underlined also in official institutions' reports, the effect of a financial crisis imported from abroad, coupled with the sovereign debt crisis of Southern Europe, caused a spike in spreads with respect to German bonds, raised the cost of funding for banks, whose risk was, as I already said before, equated with sovereign risk. The effect on the real economy that was already experiencing sluggish growth was inevitable. However, recent projections of the International Monetary Fund and Bank of Italy report signs of recovery, thanks also in part to the reforms and measures for growth that were passed by our government. The spread decreased significantly and is currently around 230, 250 basis points, starting from levels that were 200 basis points before the crisis, but reached 550 basis points in November 2011. Furthermore, Italy continues to rely on a number of strengths. Private debt of non-financial companies is approximately 80% of GDP, which is amongst the lowest in the Eurozone. Families have an elevated net worth. The industrial system is solid and capable of succeeding in international markets. Italy is the second largest European industrial and manufacturing economy in Europe, and is second only to Germany in the ratio of exports to GDP, 25% versus 44% in Germany. Italian exports are amongst the most diversified in the world and can contribute significantly to reversing the negative cycle, compensating for a weak internal demand. The expected growth of the emerging markets that will grow at an average rate of 5% in 2013 and 5.4% in 2014 will boost Italian exports. Has been calculated that 1 percentage point in growth of exports can result into 0.25% increase in our GDP. Exports are therefore an essential engine for growth, and Italian institutions are focusing their efforts in this area. The banking sector, among all in Italy, is one of the primary strengths of the Italian economy. Due to a traditional business model and prudent management practice, Italian banks have been able to shield themselves from some of the worst effects of the financial crisis. Also, in the words of the governor of the Bank of Italy, Mr. Ignazio Visco, the banking system has moved from very solid starting positions and has withstood in the last 5 years 2 profound recessions. According to IMF, the Italian financial system has demonstrated a considerable capacity for recovery vis-à-vis the domestic and European crisis. The robustness of Italian banks is even more critical in light of the pivotal role that they perform in the economy. As you probably know, the Italian economy is strongly based on the financial strength of the Italian banking sector. Loans to clients exceed 60% of total assets, where the average of the more relevant for European other countries is 37%, while financial assets are 25% compared to 41% in the other European countries. Italy's share in the total Eurozone financing to non-financial companies is 19% of total, while the total GDP of Italy is 17%. So if we compare the efforts of the Italian banking sector towards the economy, the Italian economy is higher than the share of Italian GDP versus the European GDP. So Italy has experienced a less severe decline in financing to its enterprises. As of July 2013, it has decreased of minus 4% on an annual basis. than the average Eurozone that decreased minus 6%. And in this scenario, the commitment of the Italian banking industry toward the small and medium enterprises, the corporate sector in general, also toward the families, remains strong, and it results in multiple initiatives aimed at mitigating the effects of the crisis on the economy. Such initiatives implemented in cooperation with governmental institutions helped sustaining financial flows, in particular with respect to the more vulnerable sectors, such as small and medium enterprises. And now we are looking with optimism to this most recent data, which show that our GDP in the last quarter of 2013 should come back to a positive figure. And now let me close with some remarks very rapidly concerning the subject of Islamic Islamic financial instruments as concerns the commitment, the interest of Italian banks to this world, of this sector. Well, we have been studying this subject since, I would say, at least 2006, 2007. Unfortunately, when we were becoming more concrete in defining the legislative initiatives that should be taken in order to introduce these instruments in our legislative framework, the financial crisis first and the economic crisis secondly arrived also to Italy, and this determined a lowering of our, let's say, our commitment in introducing these instruments. I don't say, of course, it's just to justify, even though logically it should be the reason to accelerate works, but resources were limited, and we were requested to focus on day-by-day initiatives that could help our customers with the traditional instruments already available in the Italian scenario. But thanks to these positive perspectives that now we are witnessing in these months, we are personally, I'm sure, and I'm very optimistic also as far as concerns our commitment in this subject of the introduction of the legislative modifications, evolutions that we need to enhance in our framework in order to allow Islamic finance instruments to become at least as much interesting as our traditional instruments in Italy, because as you know, today the situation is that Islamic financial instruments are not per se forbidden in the Italian legislative framework, but they are not viable from a fiscal point of view, because their building, their architecture would need to create such financial vehicles and structures that would make them not comparable in terms of economic interest for the investors. So our aim is to modify the law, the tax laws that will allow these instruments to become a reality also in our country. And personally, I believe that we have a wonderful opportunity to propose these changes in the laws inside a document that has been presented by our Prime Minister to the country in the last months, last September, which title is Destination Italy. It's a document, it's a project finalized to remove a number of obstacles, constraints that today make foreign investments in Italy less interesting than they could be. So we think that this document could be the right vehicle to introduce, to propose the changes that will be necessary, and I hope that with the cooperation of our institution and also with the interest of our friends from the Arabic world, it will work, and we will come to the conclusion of this story that it's really interesting, that still needs some deepening, but that we believe that can be brought to a positive end. Thank you.